From Creamer Media in Johannesburg, this is the Real Economy Report. Real estate investment trust Growthpoint Properties expects to start construction on the first 2 towers of the Olympus development in the coming months, as the company nears the 75% pre-sales mark. Marlene Arnoldi visited the site.
The R2 billion mixed-use residential and retail development Olympus in Sandton has sold 160 units out of 283 units in the first planned tower, comprising 60% by area and 70% by value, including a R45 million penthouse suite. The first tower will comprise 22 stories, including hotel rooms and residential units, a spa, sauna and infinity pool, as well as a marble restaurant on the 18th floor. Among the value-added offerings of the residential units are turnkey design elements that customers can choose from before the start of construction. The same principle will be followed with the second tower of Olympus in due course. Growthpoint CEO Estienne de Klerk tells Engineering News that the second tower's units will be adapted according to demand and may be similar or different to that of the first tower. He elaborates on the development so far.
So Olympus is a trading and development opportunity for Growthpoint. We've got on a JV with a residential developer called Tricolt, and we've done a soft launch of this development, which is located just adjacent the Discovery building, and we've actually been incredibly surprised as how popular the development is and how many units we have already sold without actually formally going to the market. So the idea would be to probably, and the development's actually got 2 towers, so at this stage we're really marketing the first tower, and the idea was to get roughly about 75% pre-sales before we actually start or commit to the development. So that on the current trajectory should be within the next couple of months actually.
The company sees strong demand for residential property in Sandton as a growing economic hub, as well as continued demand for office property. De Klerk tells us more about the market landscape.
Growthpoint's not particularly a residential specialist. They're our JV with Tricolt. I mean, the idea on the residential side is very much trading and development, so develop to make a profit and exit the development. So it's not an investment for us at all. In respect of the commercial office space, I mean, I would suggest that clearly Sandton was, of all the precincts in the country, the most affected by COVID, and to some extent we're still suffering from a bit of a hangover in this precinct as a result of that. And the reason for that is that many of the knowledge-based businesses are in Sandton. So the banks, the attorneys firms, many of the audit firms, professional firms, asset managers, financial advisors, and many of these businesses have actually not necessarily grown in this period. But over the past year, what we have seen is demand coming back from small businesses back to Sandton, and I think there's quite a process of tenants moving from, let's call it, poorer quality properties to better quality properties, because the pricing is actually very attractive in Sandton at the moment. So we've managed, if we take our results up to June last year, we managed to reduce our vacancies in Sandton by a third, so that's quite material, and hopefully that trend continues. It remains an incredibly competitive market. There is still probably close to 25% vacancy in Sandton, which is quite a significant amount of space. Our vacancy is now down to about 20% of our portfolio, and there is also a little bit of a dynamic that some of the office space is coming out of the market in that it's been converted to affordable residential in certain cases, but that is kind of reasonably small in the scheme of things. So we do really need the economy to grow. A company the size of Growthpoint and the scale of our business, we are quite linked to the economy, and that is the single biggest factor that would drive demand in office space.
Growthpoint is involved in another joint venture in the residential space with Black Brick Hotels and Setso in respect of the Riverwoods complex in Bedford View. The companies converted an existing office property, which used to be Airports Company South Africa's head office, into residential and hotel units. About 75 of the property's 163 residential units have been sold, comprising studio, one-bedroom and two-bedroom sized apartments. The residential units started being occupied in December last year, while the 91 hotel units on the property started operating in May last year. De Klerk adds his insight on the conversion of office space to residential units as well as the complex's recreational features.
The first principle is that not every office is actually convertible to residential. The specific example is called Riverwoods, the Riverwoods office park, which we then converted to Riverwoods residential accommodation, and the units were very much targeted on first-time home owners. So reasonably, smaller studio, one-bedroom and two-bedroom units. Pricing points starting around about 600,000 up to roughly about 2.5 million rand. And we've actually been surprised as to how successful that development has been. But the context is that it's in a residential area in Linksfield, very close to a school, a very well respected school, and it had a very leafy, country feel in this park. So it was a park with smaller buildings that could be easily converted actually to residential. And as such, we effectively took this park that was roughly about 11,000 square meters and created 250 odd units for the market, and we've pre-sold roughly about 80%. So that development's now done. It's got very good amenity. We've got paddle courts, we've got swimming pools, there's collaborative workspace, there's a restaurant, there's a gym. So all these factors have assisted, and then we're also running a hotel, but where people have taken the investment units and put them into a hotel pool effectively, and that hotel is busy ramping up accommodation as we speak. So the reality is for us to do that, the property has to actually work in terms of the space, that the design, the space for the property, and then secondly, it is sort of a last resort in a way. And most of our properties, where you've got vacancy, the counter of that's occupation. So if we're running in Sandton at a 20% vacancy, that means that the properties are 80% full. So predominantly they're worth more than actually disposing of them for residential conversion, where the pricing point per square meter is quite low still.
That's Creamer Media's Real Economy Report. Join us again next week for more news and insight into South Africa's real economy. And don't forget to listen to the audio version of our Engineering News daily email newsletter.